Raising your deductible can lower your premium. That sounds like an easy win. Pay less every month. Save money over time. Simple. But the real question isn't whether a higher deductible lowers your bill. It's whether you'll regret it the first time something goes wrong. Because the deductible you choose today decides how much financial pressure you feel tomorrow. In this video, we're breaking down when raising your deductible truly saves money and when it quietly shifts more risk onto you than you realize. Why this decision feels easier than reality. On paper, raising your deductible looks straightforward. Your insurer offers a simple trade-off. Accept more out-of-pocket responsibility and your monthly premium drops. If increasing your deductible from $1,000 to $2,500 saves you a few $100s per year, it can feel like an obvious financial upgrade. But this decision is rarely just about math. It's about risk tolerance, liquidity, and timing. Most homeowners focus on the monthly savings. They see the lower premium and assume the change is automatically smarter. But the premium is predictable. Losses are not. The real question isn't, how much will I save? It's, if something happens next month, am I prepared? Insurance is designed for unpredictable events. When you raise your deductible, you're absorbing more of that unpredictability yourself. For some households, that's perfectly reasonable. They have emergency savings, stable income, and the flexibility to handle a larger repair bill without stress. For others, the higher deductible turns a manageable problem into financial strain. This is why the deductible decision is less about getting the lowest premium and more about choosing the level of volatility you're willing to carry. Before looking at numbers, you have to understand what you're actually trading, and that trade is risk. The real math behind raising your deductible. Now let's slow this down and look at the numbers the right way. When an insurer offers to lower your premium in exchange for a higher deductible, they're making a calculation. You should too. Imagine this. You currently have a $1,000 deductible. Your annual premium is $1,800. Your insurer offers a $2,500 deductible, and your premium drops to $1,500. That's a $300 annual savings. At first glance, that feels like a win. But here's the real comparison. You're increasing your deductible by $1,500 and saving $300 per year. That means it would take 5 years of no claims just to break even. If you file a claim in year 2, you've saved $600 in premiums, but you're paying an extra $1,500 out of pocket. That's a net loss of $900 compared to keeping the lower deductible. This is why the deductible decision is fundamentally about probability. How likely are you to file a meaningful claim within the next few years? No one can predict that perfectly, but you can look at factors like age and condition of your roof, local weather patterns, claims history, emergency savings. Raising your deductible only saves money if claims remain infrequent. Otherwise, it simply shifts cost forward and concentrates it into one stressful moment. Understanding that break-even point is where smart deductible decisions actually begin. When raising your deductible makes financial sense. There are situations where raising your deductible is not just reasonable, it's smart. The first is when you have solid emergency savings. If covering a higher deductible wouldn't create stress, debt, or delay repairs, then you're in a position to absorb that risk. In that case, lowering your premium and keeping more money month to month can be a rational move. The second is when your home's major risk factors are stable. If your roof is newer, your plumbing has been updated, and you're not in a high-risk storm zone, the probability of a near-term claim may be lower. That shifts the math in your favor. Another factor is claims behavior. If you already avoid filing small claims and treat insurance as protection for major events only, a higher deductible aligns with that mindset. You're essentially formalizing the strategy you're already following. And finally, long-term planning matters. If you expect to stay in the home for many years and the premium savings compound over time without frequent claims, the financial advantage grows. In these situations, raising the deductible isn't gambling. It's intentionally retaining risk you can afford to carry, but that only works when the risk truly is affordable, and that's where the next section becomes critical. When raising your deductible can backfire. A higher deductible sounds efficient until the timing works against you. The first way it backfires is simple. You need the money sooner than expected. If a loss happens 6 months after raising your deductible, the premium savings are minimal, but the out-of-pocket jump is immediate. That's the risk concentration most homeowners underestimate. The second issue is liquidity. It's one thing to theoretically handle a $5,000 deductible. It's another to access that cash quickly without selling investments, draining reserves, or putting repairs on high-interest credit. Insurance claims rarely arrive at convenient financial moments. Another common problem is percentage-based storm deductibles. In some regions, raising your deductible means agreeing to a higher percentage for wind or hail. On a $400,000 home, even a 2% deductible is $8,000. That can turn a routine storm claim into a major financial event. There's also the psychological factor. A higher deductible can discourage filing legitimate claims. Homeowners sometimes delay repairs because they don't want to absorb the deductible, and that delay can worsen damage. In short, raising your deductible shifts volatility onto you. If your financial situation can absorb that volatility calmly, it works. If not, the premium savings may feel insignificant compared to the stress when something goes wrong. The key isn't choosing the lowest premium. It's choosing the level of uncertainty you can comfortably live with. How long do you plan to stay in the home? One factor that rarely gets discussed in deductible decisions is time horizon. How long do you actually plan to stay in the home? If you expect to move within the next year or two, raising your deductible may not provide enough time for premium savings to offset the added risk. The break-even math we discussed earlier becomes much tighter over short periods. But if you plan to stay for 5, 10, or 15 years, the equation changes. Premium savings compound over time. If you go many years without filing a claim, those savings can meaningfully add up. However, long-term ownership also increases exposure to risk. The longer you own a home, the greater the probability that something eventually happens. A storm, a pipe failure, a roof issue. Over extended periods, losses become statistically more likely, not less. So the decision becomes a balancing act between time and probability. Short-term owners benefit less from higher deductibles because there isn't enough time to accumulate savings. Long-term owners benefit only if they're financially prepared for the eventual claim that may come years down the road. Time doesn't eliminate risk. It just changes how the math plays out. And understanding that timeline helps you choose a deductible aligned not just with your finances, but with your plans. The emotional side of deductibles. There's also something less visible at play in this decision: stress. Insurance is partly financial, but it's also emotional. A lower deductible provides psychological comfort. When something goes wrong, the out-of-pocket impact feels manageable. There's less hesitation about filing a claim, less anxiety about repair costs. A higher deductible changes that emotional dynamic. Even if the math works in your favor over time, the moment of loss feels heavier. The deductible isn't theoretical anymore. It's a real number attached to a real repair bill. For some homeowners, that pressure is motivating. It encourages savings and discourages small claims. For others, it creates tension and second-guessing. If a higher deductible would cause you to delay necessary repairs or avoid filing legitimate claims out of fear of the upfront cost, it may not be the right choice, regardless of premium savings. The best deductible isn't just financially tolerable, it's emotionally sustainable. Insurance should reduce stress during difficult moments, not amplify it, and that balance between savings and peace of mind is often more important than any spreadsheet calculation. Simple framework for choosing the right deductible. By this point, the deductible decision should feel less abstract. Now let's simplify it into something actionable. Start with one question. If a claim happened tomorrow, could you comfortably write a check for your deductible without debt, panic, or delay? If the answer is no, that deductible is probably too high. Next, calculate your break-even window. How many years of premium savings would it take to offset the higher deductible? If it takes 5 years to break even, ask yourself how confident you are that you won't file a claim within that period. Then consider risk exposure. Is your roof older? Are you in a hail or hurricane zone? Have you filed claims before? Higher environmental risk shortens the window before a loss becomes statistically likely. Finally, think behaviorally. Are you disciplined about emergency savings? Do you avoid filing small claims already? If so, a higher deductible may align with how you naturally manage risk. This isn't about chasing the lowest premium. It's about aligning three things: your financial cushion, your exposure to loss, your tolerance for volatility. When those three align, the deductible choice becomes clear, not because it's the cheapest option, but because it's the most sustainable one. Why insurers want you to raise your deductible. There's another angle worth understanding: why insurers often encourage higher deductibles. It's not just about giving you a discount. Higher deductibles reduce small claims. Small claims are expensive for insurers to process relative to their size. By increasing deductibles, insurers filter out minor losses and limit administrative costs. It also stabilizes risk pools. When homeowners retain more minor risk, insurers only step in for larger events, which makes losses more predictable and pricing models more stable. From the insurer's perspective, a higher deductible aligns incentives. It encourages policyholders to treat insurance as protection against major losses rather than a maintenance plan. But here's the key distinction: what's efficient for the insurer isn't automatically optimal for you. Lowering claims frequency benefits insurance companies. Whether it benefits you depends on your finances and risk profile. Understanding this dynamic helps you view deductible recommendations more objectively. When an insurer offers savings for raising your deductible, they're not being generous. They're adjusting risk. The real question is whether that risk adjustment works in your favor, and that's where we bring everything together. The real question isn't should you, but could you? By now, you've seen the math. You've seen when raising your deductible can save money, and when it can quietly increase stress. But the decision ultimately comes down to one simple question: not should you raise it, but can you handle it? Can you absorb that higher deductible tomorrow without changing your lifestyle? Without borrowing? Without delaying repairs that protect your home? If the answer is yes, raising your deductible can be a strategic move, especially if you consistently avoid small claims and maintain strong emergency savings. If the answer is no, then the premium savings aren't true savings. They're borrowed comfort, exchanged for future pressure. Insurance is about smoothing volatility. A deductible shifts where that volatility sits. With a low deductible, insurance absorbs more of it. With a high deductible, you do. Neither choice is inherently right or wrong. The right choice is the one aligned with your financial resilience. Because when something goes wrong, you don't want to be debating whether you made a mistake months earlier. You want clarity, and clarity comes from choosing a deductible you can live with, not just one that looks good on paper. Final resolution. Raising your home insurance deductible isn't about chasing the lowest premium. It's about deciding who carries more of the risk, you or the insurer. If you have strong savings, stable finances, and you treat insurance as protection against major events only, a higher deductible can be a disciplined, long-term strategy. If a larger out-of-pocket expense would create stress, debt, or hesitation when repairs are needed, the premium savings may not be worth it. There's no universal best deductible. There's only the deductible that fits your financial reality. When you understand the break-even math, the probability of claims, and your own risk tolerance, the decision becomes clear, not emotional. Insurance works best when it's aligned with how you actually live and manage money. This video is for educational purposes only and does not constitute legal, financial, or insurance advice. Insurance company practices, pricing, and regulations vary by provider and jurisdiction. Readers should review official policy documents and consult qualified professionals regarding specific insurance questions or decisions.